Hello, welcome to all. In continuation with the last class, we are discussing about decision making chapter. So we completed CVP analysis. Now we will see that some applications of CVP analysis and cost concepts. This is related to short run decisions which are discussed now. That is outsourcing decision, sell or further process, minimum pricing decision, keep or drop decision, special order decision, product mix decision. Out of this, first decision will be outsourcing decision. This is the decision which making outsourcing decision is a decision if you want to do something, or if you want to manufacture something, then you can manufacture on your own or you can outsource that product to the other persons. For this decision, we must see the outsourcing enable forms for two alternatives. That is, it must reduce the cost and benefit from supplier efficiency. Then we will go for outsourcing decision. So when we have reduced our cost and it must be benefit by supplier efficiency, then only we will go for outsourcing. Otherwise we will manufacture on our own. Here, for the outsourcing decisions, there may be a single component or more than products. And there may be a cost making, and we will see if it is a single component, we will see the cost of making, that is variable cost of manufacture and a specific fixed cost and opportunity cost. If it is related to cost of buying, then we will see just purchase price, any other cost related to that. Next, if you are going for more than one product, then we will see first which is the product is not available to manufacture on our own. Then we will see that, and after that, outside price, what is the outside price, and we will deduct the variable cost, whatever the variable product cost, and we will get the savings. So variable cost savings. This savings, we will see from savings, we will see the rank basis. When will be outsourcing decision will be accepted? If incremental cost savings plus opportunity cost less than incremental cost, then reject the outsourcing unless qualitative factors impact the decision. Or if incremental cost saving plus opportunity cost greater than incremental cost, then accept outsourcing. If incremental cost saving plus opportunity cost equal to incremental cost, then you may accept or you may reject the cost. Here with them some qualitative factors is there. No, what is the qualitative factors? It may be financial stability of supplier, quality of goods, confidentiality, availability of labor and resources, reliability of supplier demands. That are may all is. When should company outsource is there? When should company outsource? A firm generally decides to outsource when, if it feels it is required. First we will see the two options, that is, one is reduce the cost and it must be benefit to the person. So first, if it is cost less rather than to manufacture it internally, if it is less, it cost was rest when we manufacture it item. Next, if the return of the necessary investment to be made to the manufacturer is not attractive enough, even though we are manufacturing goods, we are not getting the enough returns, then we will go for outsourcing. If the company does not have requisite skilled laborers, manpower persons is not there, then we will go for outsourcing. If concern feel that manufacturing internally will mean additional labor problem, so if it is a additional labor problem, we will go for outsourcing. If advocate manpower is not available to take charge of extra work manufacturing, and component shows a seasonal demand resulting in considerable risk of maintaining inventory. So if we manufacture, it will problem for inventory storage. It is a seasonal business, and if transport and other infrastructural facilities are adequately available, if the process of making is confidential or patented, so we can't maintain that confidentiality. Then if there is a risk of technology obsolescence of the components, such that it does not encourage capital investment in the component, these cases the person will go for outsourcing. Always go for outsourcing. One illustration here: DBA manufactures and sells 25,000 table fans annually. Okay, 25,000 table fans. One of the component, that is component means raw material required for fan, is purchased from an outside supplier at price of 190 rupees. So he is purchasing at the cost of 190 rupees. 25,000 fans will be cost of 190 rupees. Okay, next, annually it is purchasing 25,000 components for its usages. So for one component we will arrange one fan, so we will purchasing 25 components. For that outside, if we purchase, that cost was 190 rupees. Okay, the production manager is of the opinion that if all the components produced at own plant, then what is the cost? They will feeling that they will produce on their own, then they will save. So for that they are provided some cost. Next, provided more flexibility to increase the annual production by another 5,000 units. So they will increase their fans 5 units. So now they are selling 25,000. Then future, if they manufacture the component, then they will arrange for 5,000 plus, means 30,000. They will arrange 30,000 sales. Sales will increase to 30,000. Next, they provided the component cost: direct material 80 rupees, direct labor 75 rupees, factory overheads, that is 70% variable, means 40 into 70%, it will be 28 rupees. Total cost will be 195, means 80 plus 75 plus 28, 183 will be the cost. So as 183 is our cost, if we purchase from 183 is our cost, and if we purchase outside, it will get 190 rupees. So if we see directly from this, we will get that we manufacture is better option. We manufacture that better option. Because of that, 183 rupees is our cost, and if we purchase from outside, it will get 190 rupees. So only seeing the financial, you can't come to the decisions. Next, the proposal of the production manager was referred to the marketing manager for his remarks. He pointed out that to the market of additional units, the overall unit price should reduce by 5% and additionally 1 lakh per month. So there is some issues. What is that issue? That overall unit price was decreased to 1%, 5%, and additionally 1 lakh rupees per month was incurring for advertising their product. Presently, selling price contribution as per fan are 2,500 and 600 respectively. Okay, no other increase or decrease in all expenses as a result of this proposal. So 2,500 is the selling price and contribution is 600 rupees. That 190 rupees, means 190 rupees, what is their purchase price? They provide no purchase price. So if we see that, we will get the variable cost, this amount of sales minus contribution minus that amount of purchase price, we will get the variable cost for the production of fan. Okay, since making cost of component is more than buying cost, the management asks you analyze the make or buy decision on unit basis and total basis. Recommend the most profitable alternative, most benefit alternative. So they are asking for they will buy or they will outsource the decision. It is related to make or buy outsourcing decisions. So we will see that difference and we will tell that which is better option. For the purpose of this, if DBA purchase 25,000 units, 25,000 of units of manufacture components to manufacture, that is we will get 25,000 fans annually we will sell. The external purchase price components will be 190 rupees. It is the option of manufacturing this component in house. This component which is 190 rupees component is there, no, this 190 rupees component they may manufacture on their own. Then the cost structure will be direct material 80, direct labor 75, variable factory overhead 40 into 70%. Only we will take for the purpose of this product 28. Total will be 183. If analysis that if DBA decided to manufacture the component in house, the following would be impact. What is the impact? First one, we will increase our sales, that is production capacity will increase from 25,000 fans to 30,000. Next, variable cost of production of fan would be 1,710 per unit. Next, fixed factory overheads, that is 40 into 30%, 12 rupees per component would be incurred irrespective of whether component is produced or not. Therefore, this is cost not considered. Next, for this we are incurring 1 lakh rupee per month, that is advertisement charges. Increase in advertising expenses would be 1 lakh per month or 12 lakhs per annum. Next, overall selling price will be decreasing 5%, so it will be 95%. So price, what is the price value provided? Sale value will be 2500. From 2500 into 95% means it will become 2375. From 2500 to 2375, now the cost, now the sale value. Next, current contribution. For decreasing of this profit, then our contribution will be current contribution considering a procurement of price of 190 rupees per unit is 600 rupees per fan. So if you purchase the product, then contribution will be 600 rupees, which is provided there, or as calculated above. For the if you produce the variable cost, that is 183 which is produced there, no, that is cost they manufactured. Based on that 183 rupees was variable cost. This would result in increase in contribution by 7 rupees per fan. That is procurement price will be 190 for purchased, but if you manufacture our own 183 rupees, so there is 7 rupees difference, so contribution will increase 70 rupees. For 600 rupees plus 7 rupees it will increase, but there will be decrease in sale value, that is 125 rupees. So overall the contribution in component produced in house would be 482 rupees. So if we purchased, the contribution was 600 rupees. If we manufactured, the contribution will be 482. So to summarize the above, they provided that first, selling price for fan, normal case, when you are procurement, if you purchased or if you outsourcing, that is per fan will be 2500 and contribution per fan will be 600 rupees. If we produce 30,000 components, then selling price will be 2375 and contribution will be 482. So there is a incremental loss by switching in-house production. Would be 17,40,000. That is incremental loss will be 5,40,000. Incremental loss will be 5,40,000 plus additional annual advertising expenses will be 12 lakhs. So on a per unit basis, it would loss of 58 rupees per fan. So if you see the overall figure, then we will get the loss. Then what will we give provide a recommendation that If production increases from 25,000 fans to 30,000 fans, it would not profitable to make this component in house. So their volume was increasing but sale price is decreasing, then your profit will be decreasing. Because of that, overall profit will decrease by 17,40,000. However, DBA may prefer to make component even though it could be financially beneficial to buy from outside suppliers. Sometimes qualitative factors become very important and can override some financial benefits. This can be coupled with uncertainty about the supplier ability or intention to maintain the price, quality, delivery dates of the components. So alternatively, DBA may continue with the sale of 25,000 units without any price reduction and advertising cost will be saved. The component required only 25,000 fans may produce. Then here the contribution will increase 1,75,000. So thus DBA may choose the alternative after due and careful consideration of facts. So we will provide the data. If you go for this side, this is the position. If you choose this one, this is the position. Then you can choose whatever you want. That is related to first method, that is making or buying or outsourcing the product. Next, sell or further process. Sell or further process. This is related to if you have a product where decide whether joint product to be sell at split up point or further process will be required. We will decide based on that. Here for this product, these are two rules will be exist. To decide either to sell a component or product or raw material or its alternative process if further by incurring additional expenses. So you will decide if you sell here only or you want to incur some expenses, after that you will sell that. So joint product is the main here. From that joint product you may split up point or you may further process. So once only the incremental cost and revenue of the further process are relevant here. Only the incremental cost and revenue will be the relevant here, and joint process cost will be irrelevant, that is a sunk cost. What will be see here? We will see this incremental revenue from further processing will be see, that is revenue after further processing minus revenue of split up points. What is the revenue of a split up point? Then minus total further process cost. What is the variable cost plus additional fixed cost? Further processing cost. If the net benefit is positive, then we will further process. If the net benefit is negative, then sell at split up point. Okay, here there are two rules for this. Only the incremental cost and revenue of the further process are relevant here, and joint process cost are irrelevant here, that is sunk cost. We will not include anywhere the joint process cost. Next, qualitative factors. Some qualitative factors are also we will see that. Qualitative factors are to processing further decision includes resource availability such as readiness of employee to work extra hours to further process the product and availability of material required for processing. Next, it influences the customers. They prefer original product. For example, they provided one example. A process industry manufacture 3 joint products A, B and C. As C has no realizable value unless it undergoes for further processing after at the point of separation. So it does not have any realizable value. If it does not processing it. So the cost of details, they provided their cost. If up to point of separation, that is marginal cost was 30 rupees and fixed cost was 20 rupees. Next, after point of separation, marginal cost will be 15, fixed cost will be 5 rupees. So we will take after point of separation cost, we will take for calculation up to the point of separation. We will not take that cost, it is a irrelevant, it is a sunk cost. This point only we will explain it here. So only the incremental cost and revenue of the further process are relevant, the joint process cost are irrelevant. So this 30 and 20 are joint process cost, it is irrelevant, that is sunk cost. After point of separation, whatever expenditure you are incurring, that is 15 plus 5, it is related to our cost. And if we incur that 17 rupees, we will get C can be sold at 37 rupees. 37 rupees minus 20 rupees. 37 rupees minus 20 rupees, that is 17 rupees, we will get the contribution for joint production process. So cost incurred C up to point of separation is irrelevant decision making. For decision making, joint product are results same raw materials and same processes operations. After separation, it will be considered for specifically for product C. It is specifically for product C, so it will be included. Next, after further processing, product C will contribute 17 rupees. So if you further processing is done, you will get 17 rupees from C. So selling price will be 37. Cost after separation, marginal cost per unit 15, fixed cost per unit 5 rupees, contribution towards joint production cost 17 rupees. So further processing is better. C we will recommend for further processing. If you are not product C is not a joint product with the same cost structure, then it will get negative contribution on production of product C. That is if we see that all cost will be taken 30 plus 20, 30 means 30 only taken, 20 will be, that is fixed cost, so we will not consider here. 30 plus 15 rupees, 45 rupees, then it will be contribution will be 8 rupees. So hence production of product C will not be recommended when it is a, if it is not a joint product. If it is not a joint product, if it is a joint product, it will come automatically from the processor, so it will be relevant for normal cases. Next, minimum pricing decision. Minimum pricing decision, here minimum pricing decision, the price will be minimum pricing decision. The minimum pricing approach is useful method in situation where lot of intense competition. If there is a lot of competition and surplus production capacity, a clearance of old inventory. If you want to clear your old inventory, go for minimum pricing decision. This is like a offer, Diwali offer, Sankranti offer, or Dasara offer, Christmas offer, that like getting special orders or improving market share of product. We are doing some manufacturing or we got some special orders, so now we will go for whether to accept this offer or not. Are you ready for taking new product, new offer for this seasonal sale, the type of minimum. So when we accept or not, we will see that what is the minimum pricing, how much we will get, that we will calculate. So here minimum pricing will be what is the incremental cost plus what is the opportunity cost. So if I accepted this offer, what is my opportunity cost, that will be added to this, then we will get minimum price. So incremental cost of manufacturing plus opportunity cost. Illustration number 6, here they provided that Excel polymers located in Sahidabad industrial area, okay, manufactures high quality industrial product. Yet industries has asked Excel polymers for a special job that must be completed within 1 week. So they got one offer, it will be completed within 1 week. So they will see what is the cost for 1 week and what is the opportunity cost for 1 week if we accept this product. So when we accepted this product, this offer, we will complete within 1 week. So for that 1 week, what is our other opportunity cost, we will calculate that. Next, raw materials R1 highly toxic will needed to complete the creative industries special job. So for the purpose of special job we need one special item that is R1. Next, R1 2 weeks ago for 7,500 for job. It was 7,500 rupees before 2 weeks. Okay. A that recently was completed. The R1 currently in stock in the excess from that job. So we have R1. Next, and Excel Polymers has been planning to dispose of it. So already they want to dispose of it. So they may use for this product, they will utilize it. So there is no problem. XML Polymers estimate that it would cost them 1,250 rupees for disposing to dispose that, and current replacement cost will be 6,000. So its replacement cost will be 6,000. Here the opportunity cost will be, if they do not have any alternative, they will dispose. So the opportunity cost will be 1,250 rupees. So if they do not dispose, we will save that 1,250. 1,250 is our opportunity cost. So if we accepted this offer, we cannot dispose that. If we want to dispose that, we will bear the 1,250. If you are not disposing, we are utilizing for the purpose, then opportunity cost will be 1,250 rupees. Next, special job will require 250 hours of labor G1. So hours G1 will be 250 hours. Next, and 100 hours of labor G2. So from G2 we require 100 hours. Next, 100 hours we required 250 hours from G1. Okay, 250 100. Excel Polymers pay their G1 and G2 employees for 630 rupees and 336 respectively for 42 hours work per week. So if they work per week weekly, they will get their amount of 630 rupees and 336 rupees. So we want 250 hours from G1, 100 hours from G2. Next, XML Polymers anticipate having excess capacity. So we have excess capacity from G1 150 hours. So we require 250 hours and we exist 150 hours. So we want to pay only 100 hours. Next, and G2 we require 100 hours. We have 200 hours, so we have excess hours. So we do not have any pay for G2. Only we need to pay G1 for 100 hours. Next, what is the cost 100 hours in the coming week? And Excel Polymers can also hire additional G1 and G2 labors on hourly basis. These part-time employees are paid on hourly wage based on wages paid to current employees. Okay. Here what is the G1 cost? For 630 rupees for 42 hours. So we need 100 hours. 630 divided by 42. 630 divided by 42 into 100. We will get something one amount. That is the opportunity cost. So employee the opportunity cost, and disposal of asset done disposal is there, no, that is the opportunity cost we will get for this. Next, calculate the minimum price of that XM Polymers should bid of this job. Here, opportunity cost of labor, that is the G2 labor has zero opportunity cost as there is no other use for the time already paid for and is available. Already we have paid excess, we do not have any opportunity from using. However, Excel Polymers need to pay an additional amount for G1 labor. This amount can be saved if the special job was not there. So for G1 labor, hours required will be 250 hours. Hours available will be 150 hours. Extra hours needed 100 hours. Cost per hour 630 divided by 42, that is 15 rupees. So opportunity cost will be 1500. If we not accepted the that offer, we will save this 1500 rupees. So opportunity cost of labor for completing the special job will be 1500 rupees. Next, opportunity cost of material. This XM polymers has no alternative use of R1. So there is no alternative R1 and they must dispose that at cost of 1250 rupees. Thus XML actually saves 1250 rupees by using the material at 80 industry special job. If you accept this special job, we use that material and we will save that 1250 rupees. Next, consequently the opportunity cost of material is 1250 rupees. That is, the opportunity cost of this resource is negative. Next, minimum price is price at which Excel polymers just records its opportunity cost. Excel polymers total opportunity cost will be we will save 1500 minus 1250 rupees. 1250 rupees. Actually 1250 will be saved by using the material for the industry special job. So opportunity cost is negative, it will be negative. So 1500 minus 1250, total opportunity cost will be 250 rupees. So minimum price of special job is 250 rupees. This is related to minimum price. This is related to minimum price decision making. And here next what we will see now means keep or drop decision. It is related to temporary close down. If you have any for example for 3 months if you want to close the business, if you close that 3 months, you will save what amount and what amount you will lose, and after reopening what amount you need to spend, that we will calculate here. For this question, for this method. After that calculation, from the both we will compare that. What is the cost as of now? If you temporarily discounted the business of production, or we will calculate expected loss. From that expected loss, if we continue the business, what is the loss? If you discontinued or shut down, what is the loss? If you continue means normal procedure, that is, if you continue, we will get that sales minus variable cost and fixed cost, and we will get loss only, because this is going to loss, so that we are closing. Next, if we discontinue or shut down, we will not have any sales, so we do not have any contribution, but we need to pay the fixed cost, no, that rent amount or something, that rent amount. We will see that what is the cost if we shut down and reopening. Once if you want to reopen, then what is the cost you need to put that amount. So we will see both losses, whichever is less, then it will be treated as better. Here discontinuance means opportunity cost will be seen here. Decision making, what is the cost, qualitative factors will be seen. So illustration number 7, what is there in illustration number 7? Rabbi Limited is considering the discontinuance of division C. The following information is given. So division A and B and division C, so it has 3 divisions, so it want to discontinue division C. For that, now division C, we will calculate what is the expected loss if we continue the division C, or if we discontinue the division C. We will calculate that. What from that both we will compare which is lower loss, then we will treat that. So we will continue or discontinue. They are decided to discontinue. Next, they provided the information: sales minus variable cost, contribution, specific variable fixed cost, divisional income. So we got that one information, that is expected loss. If we continue the division C, we will get the 1,72,500 rupees loss. 1,72,500 rupees loss. Now we will calculate if discontinuance is happen, what is the fixed cost and what is the cost to be incurred when you reopening the division C, that we will calculate now. From the given information, the rate of variable costs are 90% of the normal rates. Due to current volume of operation, there is advocate market demand, so variable cost is 90% of normal rates. Due to of we are taking large volume, they are providing 90% variable cost. So 90% variable cost, then it will increase in variable cost if you close the division C. If you close the division C, the 10% will be increased. That is, now variable cost will be 20,70,000 divided by 90% into 10% into 10. That is, it will get one amount. It will increase due to this division C close. Next, for any lower volume of operation, the rate would go back to the normal rate. So volume was decreased, then 100% will be cost. So we will increase that cost. Next, facilities realized by discontinuous division C cannot be used for any other purpose. Comment the decision to discontinuance. So here we will get 1,72,500 loss, normal loss. If we continue, if we close, what we will get the loss? That value variable cost will increase. How much it will increase? We will see that, and based on that we will calculate the expected loss. So now the given problem, Rabbi Limited is considering the discontinuance the division C, perhaps by seeing the division C income at loss of 1,72,500. So this decided because of 1,72,500. Next, discontinuance of division C might be saving of 4,14,100. So if we close this division C, we will save that fixed cost, that is related to specific avoidable fixed cost. 4,40,000 we will save. Next, on the specific fixed cost of the company, but due to this decision will not only be losing 2,41,500. So this contribution we will lose by closing this. Not only this contribution, but additional burden of variable cost of division A and B. That is, let's see the relevant cost here. Saving due to discontinuance. Specific fixed cost will be 4,14,000. Okay, and loss increased in cost due to discontinuance. That is loss of contribution. If we will lose the contribution amount 2,41,500, and increase in variable cost will be increased 10%. That is 2,30,000 will be increased. 2,41,500 contribution plus variable cost increase 2,30,000, 4,71,500. If we discontinue the business, we will get the 4,71,500. We will continue the business, we will get the 4,14,000 loss. Whichever is benefit, 4,71,500 is excess loss. So we will save if we continue the business 57,500. So in a nutshell, consider the above analysis, we can conclude that decision of discontinuing division C will not beneficial for Rabbi Limited, and it should review its decision on the basis of relevant cost approach to reach at right decision. If you not taken the right decision at the right time, you will get the huge loss. Next, special order decision. One special order decision, it is like, if you have a special price order, we can accept or reject. Here we will get that what is the main here is, we will see this law does not apply in two cases where price discrimination is required. Non-competing customers for the same market, non-competing customers for the same market, then this law will not be applicable. Or potential customers in the market that not ordinarily served, then also this cost will be not applicable. Next, these two cases it will not be applicable. Next, special order decision are based on incremental analysis. It will be based on incremental analysis. So we will see that what is the main year. That is the main year where we got the special order. We will got the special price order decision, then special order for job. It is a one-time order. It is a one-time order. So we will see the maximum price to be charged. That is relevant cost. That is relevant cost. What is the maximum price to be charged? That is relevant cost. After that, evaluation of special orders. That is relevant. What is the relevant revenue minus what is the relevant cost and what is the net benefit or loss. We will see that. Based on that, for we will accept or reject. Accept or reject. Based on that, we will accept or reject. Next, danger of consent. Okay. Illustration number 8. We will see the illustration number 8. In illustration number 8, B and Z Limited is engaged in the manufacture of plastic bottles. So it is in manufacturing of plastic bottles of standardized size and produced by joint process of machine. So it is producing bottles and produce joint process of machines. The factory has 5 machines and capable of producing 40 bottles. So it has 5 machines and 40 bottles it will produce, and the variable cost of bottle will be 0.32 and selling price will be 0.8. So 0.8 minus 0.32, we will get the contribution for bottles. The company received an offer from another company for manufacture of 40,000 units of plastic molded ties. So we are in bottle. We got the special order for manufacturing of ties. Here the price of ties will be 30 rupees and variable cost will be 24 rupees. 30 minus 24, 6 rupees. 40,000 into 6, we will get the contribution amount. 40,000 into 6 rupees, we will get the contribution. Next, in case of company takes up job, it has to meet expenses of making molds required for manufacture of the ties. Though the cost of molds is 1 lakh rupee. Out of 6 rupees contribution, we will incur 1 lakh for cost of molds. Because of we accepted the ties. If we accepted, then if you are not accepted, we will not incur this 1 lakh. Next, the company time study analysis show that machines. What is the time schedule? That it can produce only 16 ties per hour. So 16 ties per hour. How much time we required for total manufacturing? How much we required? 40,000 units we required. They produce only 16,000 per hour. 16,000 per hour. So the company has total capacity will be 10,000 hours. The company capacity will be 10,000 only, then its capacity 10,000 will be that capacity. So for ties it require 2,500 hours. It will be, that is 40,000 units divided by 16, it is become 2,500. 2,500 hours will be required for ties. Then the fixed cost excluding the cost of construction of molds during the period will be 10 lakhs. The company has ordered for supply of 3 lakhs bottles during the period. For producing these 3 lakhs, how much hours we will require? For 5 machines we will produce 40 bottles. So we will 3 lakhs divided by 40. It will become 7,500. So 7,500 for bottles, 2,500 for ties. So 10,000 hours we will require, and the capacity of machine also 10,000 hours only. So fully utilization of machine, fully utilization of machines. No, okay. Now we will see the contribution and what is the contribution for machine hours. Do you advise the company to take up the order for manufacturing plastic mold ties during the time when it has an order in its booking for the supply of 3 lakh bottles? So 3 lakh bottles means it is good only, because for 3 lakhs units it requires 7,500 hours, and we have any excessive 2,500 hours, and it will become fully utilization of machine. Okay, it is acceptable. Next, if the order for the supply of bottles increases to 4 lakhs bottles, then 4 lakhs divided by 40 means 10,000 hours became for bottles itself. We do not have excess of 2,500, so we need excess of 2,500 if we accepted the ties. So then we will compare this. So we will produce that or this. We will decide based on information. Next, based on contributions we will decide. Next, an associate company of B&Z Limited has ideal capacity and is willing to take up the whole or part of the manufacturing unit of the plastic molded ties on subcontract basis. The subcontract price inclusive of the cost of construction of molds is 28 rupees per tie. So this want to take up ties only. Determination of the minimum expected excess machine hours capacity needed to justify producing any portion of ties ordered by the company itself rather than subcontracting. So for second question we will see that what is the good and state the reason. Means if we go for ties, then we are not provide the bottles. Bottles is our regular business, and they are the regular customers. We will lose their customer loyalty when we go for ties, and ties is the single time order. We will decide that also. We will kept in our mind that point also. Okay, first statement showing contribution machine hours. Demand was 3 lakh 40,000, that is toys will be 40,000. Sales 0.8 30 rupees. Variable cost will be 0.32 and 24 rupees. Specific fixed cost will be for toys it will be 2.5, that is 1 lakh rupees is there. No, 1 lakh rupees divided by 40,000. Next, contribution 0.48 3.5. Next, machine hours required for unit will be 0.025 hours and 0.0625 hours. Contribution what we got for 2,500 for 2,500 for ties, 7,500 for 7,500 hours for bottle. So per bottles, total bottles for 3 lakh bottles we require 7,500. For that 7,500 divided by 3 lakhs, then we will get per unit. We got this per unit. Next, contribution machine hours 19.2 and 56 provided. On this, based on this information, we will calculate that. Contribution machine hours will be. Now, first question was, B&Z can accept the plastic mold ties order as sufficient number of hours, that is 2,500 hours for ties are available and would be able to generate additional benefit of 3.5 per unit, that is contribution 3.5. we will get the additional benefit units into 40,000 units ties, then that is 1 lakh 40 rupees we will get additionally. Next, if second question 4 lakh 3 lakh case, if the order for the supply of bottles increases to 4 lakh bottles, then additional 2500 hours will be required to produce the additional bottles. So here the company decide whether to utilize 2500 hours for existing bottles order or for toy order. Next, machine timing is limited factor. Machine timing will be limited factor. Therefore, contribution per machine hours for the both activities shall be calculated to decide whether the order should be accepted or not. Accepted or not. From the referring working, what we already calculated that. Therefore, BNG should utilize the remaining 2500 hours for manufacturing ties because we will get the more contribution than bottles. More contribution. Here prioritization product based on contribution per machine hours would be maximum profitable. So maximum profitable will be toys only. However, existing order fulfillment is necessary for building long-term and sustainable customer relationship because we are in bottles. We are in bottles. We will surviving in bottles because of this special order. This is a one-time offer. If we see this one-time benefit, then long-term benefit will affect. So developing and maintaining long-term and intimate relationship with the profitable customers provides valuable benefits to the company. As the relationship between the company and customers grow, a customer who is satisfied with the company's products and services tend to commit the relationship. When you are not sufficient to provide that 4 lakh units, when the customer asked, if we go for benefit, that is we produce for ties to other person, the 4 lakh person will not satisfy, then you will not come again for you there. Then tend to commit the relationship and buy more over time. Cost of keeping the existing customers is less expensive than cost of acquiring new customers. So that 4 lakhs whatever you got from your old customer, it is you do not spend any cost. For if you want new customers, you need to incur the expenditure for advertising your products, something. You need to provide discounts also. Next, hence B&Z Limited should be taken into consideration long-term supplier relation because before accepting the toys order. Based on the financial consideration, as contribution per hour is more in case of toys. Further, company may also explore outsourcing opportunity for production of toys. So if you don't, there is contribution is high. To see there, if it is possible, if you give the outsource, what is the benefit, you will see that. So don't lose for our old customers, it will build long-term relationship. Next, minimum number of ties need to be manufactured to justify the increase in fixed cost of 1 lakh rupee. To make the molds is 25,000 ties. Then the amount will be 28 minus 4. 1 lakh divided by 4, that is 25,000. Thus, as long as company has excess capacity available to manufacture more than 25,000 ties, it is cheaper to produce than to buy from subcontractors. It is cheaper. So minimum expected excess capacity hours to justify 25,000 ties divided by 16, that is 1563 hours we expected, that is minimum hours. This is related to special order. Next, price mixing decision. Here price mixing decision is one concept which is provided. There is a product. If you are a product, is for mixing your products, some requirement is there. That is, we will see this. Many times management has take decision whether to produce one product or another instead. So sometimes they will got the confusion also. We produce one product or another product. Generally on the basis of contribution they will go for each product. So other things being the same, the product which yield is highest contribution is the best one to produce. Normally we will see that contribution which is the providing best contribution, we will go based on that contribution only. But example in machine hours, then the contribution is linked with such key factors for taking decision. For example, in an undertaking the availability of machine capacity is limited. If you have machine is limited capacity and machine hours are required for 1 unit of the 2 products, out of 2 products 1 unit are different. In such a case contribution is to be linked with machine hours. Here based on your time you are required to produce, at that point of time. How should we exercise, how should we bifurcate, how should we go for manufacturing? That is the preferred, which is the preferred one. For example, they provided one illustration 9. A company manufactures 2 products, that is each product passes through 2 departments, A and B, before it became finished product. That data for the year as are under. That is, we will go with ranking for the products, then we will get answer. If we rank is high, we will select that in the product mixing. That is, maximum sale potential was product X was 7400, product Y was 10,000 for product Y, product X 7400. Selling price per unit 90 rupees, 80 rupees. Next, hours, machine hours, department A hours 40 rupees, product X will be 0.5, product Y will be 0.3. department B hours 60 rupees, 0.4 hours, 0.45 hours for product Y. Maximum capacity of department A is 3400 hours and department B will be 3640 hours. So 640 hours B, 3004 hours for A. Okay, so we will see the what is the available resources out of this, and what is the shortage and what is we required. Next, maximum quantity of direct material available is 17 kgs. So available resources is 17,000 kgs and we have hours will be A department will be 3400 hours, department B will be 3640 hours. This is available resources, direct material. And here product selling price, machines, maximum sale potential 7400, 10,000, 10,000. Okay, find optimum product mix. Purchase price of direct material will be 5 rupees. Next, here calculation of optimum product mix. So required X and required Y, materials 14,800. So departmental A 3,700 hours, departmental B 2,960 hours, and required Y will be 20,000 kgs, 3,000 hours and 4,500 hours for departmental B. Total requirement will be 34,800, but available resources was only 17,000 kgs. So we have available resources will be 17,000 kgs only, and available time will be 3,400 hours, 3,640 hours. Okay, this is that. Next, shortage will be 17,800 will be shortage, and in the form of department A will be 3,300 hours, in the form of hours of department B will be 3820 hours. Hence all three resources are limited factors. So we have material limited, hours limited, 2 and 3. So department B. So A, B, material, 3 are limited. Now we will go for rank, statement of rank. So what is the sale price? Sale price was provided was 90 rupees, 80 rupees. 90 rupees, 80 rupees was sale price. Okay. And direct material will be 10 rupees, 10 rupees. Direct material will be 10 rupees, 10 rupees. And what is provided? Direct material. Each product requires 2 kgs of direct materials. So purchase price will be direct material is 5 kg, 5 rupees. So 5 into 2 rupees will be 10 rupees. Next, department A 20, 30. Department B 24, 27. Next, contribution per unit will be 36, 31. Next, contribution per kg of raw material will be, it will become per kg, then that is 36 divided by 2, 18, 15.5. So 18, 15.5. Contribution is highest in product X. So rank 1. Product B, product Y will be rank 2. Next, contribution hours of department A will be 72 hours, 72, and for product Y 103.33. So it will be first rank. Next, contribution hours of department B, that is 90, 68.89. Then rank will be this one, product A. So we have product A will be 2 times rank, and product Y will be 1 time rank. So when we have in product mixer, when we have only 2 products, then we will go for linear program. If we have more than 2 products, then we will go for equation method. Here we have only 2 products, so we will go for linear program. We will calculate based on linear program. So what is there in linear program? So we will calculate the equation method. That is, what is there? 36 plus 31. That is based on contribution. 36 x1 plus 31 x2. Subject to 2x1 plus 2x2 less than or equal to 17,000. That is material related 17,000. Next, department A will be 3,400 and department B will be 3,640. So from out of that we will get x value and x2 value, demand constants. For graphical solution for the problem is given below. They provided the graphics. So different contributions of product mix includes P, Q, R, S, T. What is this? So from this we will construct the graphical solution for the problem given below. After that, here combination Q is not possible as it is satisfying 3 conditions out of above 4 conditions.